$348 trillion. That is the current total of global debt. Not billion, trillion. 3 times the size of every economy on Earth combined. Now here's what nobody tells you. The number is not a crisis. It is not an accident. It is not a failure of policy. It is the intended outcome of a system designed by 2 men over 2 centuries ago. You've been told that wealth is built through production, through industry, through hard work and honest dealing. Nathan Rothschild never built a factory. He never produced a single good. J.P. Morgan didn't create the Federal Reserve to protect the American people after the Panic of 1907. He designed $1694. Debt was a problem to be solved. Kings borrowed, kings defaulted. The system reset. Creditors lost. The cycle repeated. This was the old world, a world where debt had a beginning and an end. Then a man named William Peterson founded the Bank of England, and he introduced an idea that changed the architecture of civilization. The idea was simple. What if the debt never ended? What if, instead of repaying the principal, a government only ever paid the interest perpetually? The debt becomes permanent. The interest becomes guaranteed income. And the creditor becomes structurally more powerful than the sovereign. This was not a financial product. This was a new operating system for power. Nathan Rothschild understood this at a level no one else did. And in 1815, he executed a move that proved it. Napoleon is at war with Europe. The British Crown is financing the resistance. The outcome of Waterloo will determine the fate of the continent and the value of British government bonds. Every banker in London knows this. Every trader is watching. Nathan Rothschild has something none of them have: a private courier network faster, more reliable, and more discreet than anything the British government operates. On June 18, 1815, his courier reaches him before dawn. Wellington has won. Napoleon is finished. Rothschild now knows something the entire London market does not. What does he do? According to financial legend, though historians like Neil Ferguson note the details remain disputed, he walks onto the trading floor. He begins selling British government bonds, heavily, visibly, deliberately. The message is clear to every trader watching. Rothschild is selling. Rothschild knows something. Napoleon must have won. Panic spreads. Prices collapse. Everyone sells. Rothschild's agents, acting quietly across the floor, buy. They buy everything, at the lowest prices the market has ever seen. By the time the official news reaches London, British victory, Rothschild holds a dominant position in the British bond market in a single day. Not through production, not through innovation, through information asymmetry, executed with perfect discipline. But here's what most analysis miss. The trade at Waterloo was not the achievement. It was the consequence of something larger, a system Rothschild had been building for years. The real move was not the trade. The real move was what he did with the position afterward. Rothschild did not simply hold the bonds and collect coupons. He used his position in the British debt market as collateral, as credibility, and as leverage to become the primary financier to the British Crown, and eventually to multiple European governments simultaneously. The specific instrument he mastered? Consols. British perpetual bonds that pay interest in perpetuity, never requiring repayment of principal. He did not lend gold. He lent liquidity to sovereign states that could not function without it. And because sovereign debt, unlike personal debt, cannot simply be discharged, because a country cannot declare bankruptcy and walk away, the interest payments were perpetual. Rothschild had industrialized debt. He had taken Peterson's 1694 model and scaled it across the most powerful governments on the planet. Now, enter J.P. Morgan. Nearly a century later, a different country, a different problem. In 1907, the American banking system nearly collapsed. The Panic of 1907 wiped out banks, destroyed savings, and paralyzed credit markets. Morgan personally intervened, deploying his own capital to stabilize the system. He was lauded as a hero, but Morgan was not finished. In 1910, Senator Nelson Aldrich, at the suggestion of Morgan's partner Henry Davison, convened a secret meeting at Jekyll Island off the coast of Georgia. The meeting was so secretive that attendees were told to use first names only and arrive separately to avoid detection. What they designed over the course of that week, primarily under the technical direction of Paul Warburg, who wrote the core framework, would be called the Federal Reserve System. It was presented to the American public as a democratic, government-controlled institution, a safeguard against future panics. It was neither democratic nor government-controlled in the way the public understood. It was a private banking cartel, structured to give member banks, including Morgan's, the legal authority to create money through fractional reserve banking and use it to purchase government bonds. Think about what that means. The government issues debt. The banks, now operating under Federal Reserve Charter, create fiat currency to buy that debt. The government pays interest on that debt, perpetually. Rothschild's model, scaled to an entire nation, institutionalized, legally protected. The mechanism was no longer a private operation. It was now the foundation of the monetary system itself. Here is what these two men understood, and what their competitors never did. The losers in this game were the ones who tried to end it. Before 1694, monarchs borrowed and then defaulted. They treated debt as a temporary condition, something to be resolved, paid off, and closed. The logic destroyed them. The kings who defaulted lost their creditors, lost their credit lines, lost their ability to finance wars, expand territory, and project power. The bankers who understood Peterson's model, who designed systems where the debt never ended, where only the interest was ever paid, became structurally indispensable to the very governments that technically had the power over them. This is the golden rule. Power does not come from holding capital. Power comes from being the architecture through which capital flows. Rothschild did not want his bonds repaid. Repayment would have ended their relationship. Morgan did not want the government to become financially independent. Independence would have made his system irrelevant. Their goal was not to close the transaction. Their goal was to make the transaction permanent. This is not a metaphor. This is a law of financial physics. The entity that controls the infrastructure, the rails, the clearinghouse, the issuance mechanism, captures value from every transaction that passes through it indefinitely. The entity that participates in the transaction captures value once. Infrastructure compounds. Participation does not. You are not Nathan Rothschild. You do not have a private courier network. You are not J.P. Morgan. You cannot convene senators at a private island. But the underlying logic is not limited to the 19th century. It's operating right now, and it is available to you. First principle: build the toll booth, not the cart. In 2026, the most valuable business models are not transactional. They are infrastructural. SaaS platforms do not sell software, they sell dependency. The user's data, workflows, and team habits become embedded in the platform. Switching costs rise. The debt, in the form of sunk time, integrated systems, and switching friction, becomes permanent. The user pays interest every month, indefinitely. This is Peterson's 1694 model, rebuilt in code. Second principle: the perpetual claim outperforms the single sale. Examine how capital is actually concentrated today. BlackRock, Vanguard, and State Street collectively controlling more than $25 trillion in assets, manage funds that generate approximately $1 trillion annually from the U.S. debt market alone. They don't manufacture anything. They do not build anything. They hold the infrastructure. The money flows through them. They take a percentage of every dollar that passes. This is Rothschild's model, scaled and institutionalized through modern financial instruments. Third principle, avoid the fatal error of the borrower. The kings who defaulted lost everything. Their modern equivalent is the professional who accumulates consumer debt, financing lifestyle, not assets, paying interest on depreciating goods, sending perpetual cash flows to the architecture instead of building it. Every dollar of bad debt you carry is a dollar that flows from you to someone who has positioned themselves on the correct side of the infrastructure equation. The decision is binary. You are either the entity that holds the asset generating interest, or you are the entity servicing the interest on someone else's asset. There is no neutral position. The practical implementation in 2026 do not optimize for a single large transaction. Optimize for recurring claims. Build systems where your customers cannot easily leave, not through deception, but through genuine integration. Make your product or service structurally necessary to their operation. Create assets that generate cash flow without your active participation. Rental income, licensing fees, subscription revenue, equity positions that pay dividends. Position yourself at whatever scale is accessible to you as the infrastructure, not the participant. This requires patience. It requires resisting the temptation to close the transaction when leaving it open creates more long-term value. This is what Rothschild understood on that trading floor in 1815. The position he built that day was never meant to be exited. It was meant to compound. $348 trillion in global debt. That number exists because two men, and the systems they built, understood something fundamental about the nature of durable power. It does not come from producing more than others. It does not come from working harder than others. It comes from designing a system where others continuously flow value through an infrastructure you control, and where the game, by design, never ends. The anti-pattern is clear. Those who sought to repay, to reset, to resolve, lost. Those who designed permanent claims on perpetual flows won. The question is not whether this logic applies to your business, your career, your financial decisions. It does. It has always applied. The question is, which side of the infrastructure are you on? That answer is entirely within your control.